and welcome to the Monday Futures Market Outlook for July 18th, 2011. This is Patrick Sresna. For those of you that have not yet had the opportunity to try out the Evening Source Trading Room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. We bullishly crossed above that back in 2009 and remained distinctly above that 80-week moving average. We were looking for there to be some sort of profit-taking corrective cycle in the markets over the summer, and really to be the bulls have done a very good job on containing most of the selling to within just a 10% market correction. Overall, this market would have to have very significant deterioration below the 1200 level for there to really be a bearish outcome to this entire market scenario. So long as everything is contained here, then this should actually end up being a significant buying opportunity for the second half of the year. Just to make some key intermarket observations, the primary trend of that market remains bullish. We were looking for that second quarter market correction, and we wanted to see how deep and how far that market correction goes. But like we were suggesting earlier, is that so long as that 1200 level is held over the summer, then we should have a bullish second half of the year. The biggest variable in the third quarter will be the story of the US dollar. Obviously, there's all the issues in Europe and the risk that the euro may break down. But if there's any euro stability like we've more or less seen, then the US dollar, if it was to break down again and make another push lower on that index, we'll see it on the chart briefly when I pop it up in a short period of time here. But it will naturally lead to strength in commodity stocks and weakness in bonds. And so we'll see whether or not we have a return to that depending on how the US dollar plays out. Let's take a look at that S&P 500 on the daily charts using that E-mini futures contract. Essentially, we were talking about that support line at the 1295 to 1305 level, acting like a buffer for whether the bulls can maintain control of this market. Well, last week we spent the entire week consolidating right at that line. This is a make it or break it moment. So long as we're above this 1295 to 1305 area, we have to favor the bulls and that they'll be able to roll it up and actually have a push back up to the highs. But anything that consolidates below the zone, beyond just a small intraday swing that immediately comes back up, then we have to look at the scenarios that we're still stuck in the summer consolidation, and we'll have to come back maybe not only to test 1250 again, but maybe even as low as the 1220. But ultimately, so long as the consolidation remains sideways this way, it will have a bullish resolution, but it just may be later in the summer if we have a break of the support line. Next year, I want to take a look at the U.S. dollar index futures, and more or less the U.S. dollar continues to create this wedging sideways consolidation. Now, the longer that the bulls fail to make any robust push in the U.S. dollar, the greater the chance that it will actually break down. So we're watching again as another U.S. dollar rally attempt is occurring over the last 3-4 days. But again, so long as the U.S. dollar bulls continue to fail to make any significant progress above the overhead resistance levels, then we expect the U.S. dollar to potentially roll down and break down to new lows. At this stage, it would take a significant rally above the 77 level for us to want to consider a number of bullish scenarios for the U.S. dollar. Next year, I want to take a look at copper futures, and copper has continued to hold up very well. It's now going on a week or more of sideways consolidation, and it has actually done a very good job not giving back any of that rally that we saw in the first week of July. Really, at this stage, like I was suggesting, that so long as the bulls maintain above the 420, 430 area on the upside, then we should see copper actually be able to bullishly maintain a push to retest the highs of the year. Next year, I want to take a look at gold futures, and gold has very bullishly broken out above the 1560, 1580 area on the upside. And what's nice is that even after a day or two attempting to consolidate, the bulls have actually maintained gold up here. This is the first commodity that's really breaking out to new highs, 52-week highs, and really going and pushing. Really, at this stage, gold should continue in trend. at this stage, so long as and all low pullbacks are really contained above the 1550 level. Even a temporary break below that 1560 focal point and then return back up would be fine. So long as consolidations are held with support and at the support lines, we should see a return back up to not a return, but a push up to 1650, 1700, and even there's a measured move that even targets 1750. But 1750 would be something we would see 3, 4, 5 months down the road, not a short-term target as in, let's say, the next 2-3 weeks. Next year, I want to take a look at crude oil. And crude oil is not behaving as bullishly as copper and gold are, but there's room for oil to even consolidate back down to the 90-92 zone with a little corrective pattern that could, on a break of the lows of this consolidation, could have a solid test of that 90-92 area below. But overall, if the US dollar breaks down, we should see lows on crude oil. If obviously if that US dollar began some sort of robust rally, there is room for crude oil to even further consolidate back down to not only the 90 level, but theoretically could go even as low as 85 on the downside before finding its lows. A lot of which way crude goes will be a big play on that US dollar, so we'll be watching where the break on the currency front is. Finally, I want to take a look at that 30-year Treasury bond, and more or less we're back up to the highs of May and June. Really at this stage, Treasury bonds are behaving still relatively well. Haven't given over the last week, have not given up much of that spike rally we had from 2 weeks ago. Really at this stage, there is room for Treasury bonds to test a 128 to 130 handle on the upside if we see breaks to new highs. So watch for Treasury bonds here. We are right now at an overhead resistance level that could still reject, but if the bulls can actually give it a good spark a match under it and get a good push above, let's say, the 127 handle, there is even 1 to 3 more handles higher on the upside of Treasury bonds. That was your Monday Futures Market Outlook. Thank you for joining me.